Welcome to the deep dive. Today we're plunging headfirst into the pretty high-stakes world of Eutelsat Communications, ticker ETL.PA.
Right.
This company, a French satellite giant, it's really at a critical point, isn't it? Having just pulled off that bold all-share merger with OneWeb.
It's massive, and it raises this huge question.
Exactly. Has this set them up to, dominate the next generation of global connectivity? Or have they just bitten off more than they can chew? Burdened with debt, facing these huge disruptive forces.
It's a fascinating, really complex story. You've got this traditional satellite operator desperately trying, to reinvent itself in a market that's changing incredibly fast. So our deep dive today, it's all about cutting through that noise, getting to the core of this pretty intricate investment thesis.
Right.
We're going to unpack Eutelsat's business, its leadership, the raw financials, how the market sees it right now, and the unique challenges it's facing. The goal is for you to walk away with a clear, quick grasp of what really matters here.
Absolutely. And hey, if you find this kind of in-depth analysis valuable, please do remember to like this deep dives and subscribe to the Stock Analytics AI YouTube channel.
Yeah, it helps us a lot.
It really does. And for just €4.99 a month, Stock Analytics AI members get priority access to deep dives on specific tickers that you suggest in the comments. It's actually how we pick our next fascinating subject.
And what makes Eutelsat particularly interesting, I think, is just how polarized the investment view is. I mean, there are really strong arguments on both sides.
For a huge turnaround or a total collapse?
Pretty much, yeah. A spectacular turnaround, or, well, potential collapse. As of our analysis date, June 18th, 2025, the stock's at 2.31. That's right at the lower end of its estimated intrinsic value range, which tells you straight away the market has some serious doubts about where it's headed.
Okay, so how are we going to tackle this complex beast? Our deep dive today is split into two main parts. We're digging into 7 key chapters from an independent research report. So in part 1, we'll navigate Chapter 1, bonus analysis, then Chapter 2, management valuation, and Chapter 3, financial analysis. That covers the core business, who's running the show, and the numbers.
The foundations, basically.
Exactly. Then in part 2, we'll move into Chapter 4, market sentiment, Chapter 5, ownership structure, Chapter 6, risk assessment, and finally, Chapter 7, conclusion, where we'll try to pull it all together.
Sounds like a plan. Let's get started.
Okay, let's jump straight in with Chapter 1, business analysis, a new orbit or a decaying trajectory. So the report centers on Eutelsat Communications SA, that French satellite operator. Analysis date again, June 18th, 2025, share price 2.31. And we're coming at this with a value investing mindset, right?
Absolutely. Digging into the business, competitive advantages, management, and what it might actually be worth, intrinsically worth.
So the core business, it's really undergone a radical shift.
Oh, completely. Historically, they were all about geostationary orbit, GEO satellites, those big ones fixed high up, mostly selling wholesale capacity for TV broadcasting. That was their bread and butter.
Right.
But the 2023 merger with OneWeb, that was a total game changer. It created the world's first fully integrated GEO and low Earth orbit, or LEO, operator.
LEO being much closer to Earth, faster internet.
Exactly, lower latency. It completely flipped Eutelsat's strategic direction, a massive pivot.
And you can really see this shift in the revenue streams, can't you? They've got these 4 main operating verticals now, based on their first half FY25 figures.
Yeah, the split is telling. First, video, still the biggest chunk at 52% of revenue. That's the legacy GEO business. It's declining, but still throwing off cash.
A cash cow, but maybe a melting one?
Potentially, yeah. Then there's connectivity, making up the other 48%. This is the new strategic core, the growth engine, increasingly powered by LEO for fixed and mobile stuff, and they also have government services, secure comms, that kind of thing.
Okay, but here's the rub, isn't it? This new LEO growth, it's actually eating the old GEO business.
That's the brutal truth, yes. It's cannibalization. The growth in LEO connectivity isn't just new business on top. It's actively pulling customers away from GEO services because, well, LEO performance is generally better for data.
And they even quantified this.
They did. Eutelsat reported a staggering $535 million goodwill impairment charge on its GEO assets in the first half of FY25.
Wow.
And they explicitly cited a transfer of demand from GEO to LEO. Customers are voting with their feet, basically.
So that puts immense pressure on them to grow LEO super fast, just to stand still overall.
Exactly. It's a very, very tricky race against time. Can LEO ramp up quickly and profitably enough to offset that legacy decline? That's the billion-dollar question, maybe literally.
So their key products kind of reflect this split personality, right? Geo stuff like direct-to-home TV, but then the OneWeb LEO services for high-speed broadband.
Right, but the really unique piece, arguably, is their integrated hybrid services.
Combining both.
Yes. Using both GEO and LEO together to offer these sophisticated, super resilient solutions for demanding clients. Think reliable connections for ships at sea, planes in the air, secure government networks.
Things where you absolutely cannot lose the connection.
Precisely. And that's something that, a pure play LEO operator like Starlink or a legacy GEO operator can't easily replicate. It's their potential differentiator.
So where does this place them in the market now, post-merger?
They're now one of the big 3 global satellite operators by revenue. The scale is huge, 35 GEO satellites, over 600 OneWeb LEO satellites, a truly global footprint.
And their value proposition has evolved.
Yeah, it's not just about coverage anymore. It's about offering this mix, combining GEO's capacity and reach with LEO's performance. Their tagline is, enabling all to connect across the globe. This tiered, resilient service is key.
Okay, let's zoom out to the industry itself. It's changing incredibly fast.
Well, unbelievably fast. It's gone from being almost like a stable utility.
Predictable, maybe a bit boring.
Exactly, to this dynamic, high-growth, super competitive tech market. Just look at satellite internet. That subsegment is projected to explode. From about $5 billion in 2024 to nearly $25 billion by 2030.
That's almost a 30% compound annual growth rate?
Insane growth, driven by a few key trends.
Like?
Well, the big one is the proliferation of these LEO constellations, SpaceX's Starlink, obviously, Amazon's Kuiper coming online. Then you've got direct-to-device, D2D, connecting phones straight to satellites.
Right, cutting out the middleman dish.
Potentially, yeah. And convergence with 5G networks, what they call non-terrestrial networks, or NTN, plus industry consolidation, Eutelsat OneWeb, SES Intelsat merging, and this overall shift to digital software-defined networks. It's a whirlwind.
So the competitive landscape.
Yeah.
You've got the legacy guys like SES and Intelsat who are also bulking up.
Right. But the real elephant in the room, or maybe the rocket in the sky, is SpaceX's Starlink.
They seem formidable.
Absolutely. Vertically integrated, reusable rockets mean lower costs, aggressive rollout. They're a massive force. And Amazon's Project Kuiper is another huge potential threat waiting in the wings.
So Eutelsat's strategy is different. More high value, less consumer-focused.
Generally, yes. They aim for sophisticated, resilient solutions for enterprise, maritime, aviation, government clients. Their partnership with Orange, the telco, is part of that B2B focus, contrasting with Starlink's more direct-to-consumer play.
But can they really compete on cost? And then there's the whole regulatory side.
The regulatory environment is incredibly complex. Licenses from the ITU, national regulators, landing rights. It's a maze. But actually, this acts as a pretty powerful moat for established players like Eutelsat.
So it's a barrier to entry for newcomers.
A significant one. And Eutelsat's central role in the EU's big 10.6 billion IRS program, Europe's own secure satellite constellation, really highlights this. Governments want secure, sovereign options.
So that IRS deal is a big deal for them. Guaranteed business almost.
It's a massive anchor tenant, yes. De-risks things significantly and shows strong government backing. But you're right to mention the barriers to entry, generally massive capex needed, regulatory hurdles, scarcity of orbital slots and spectrum, the tech expertise. It's not an easy game to get into.
Okay, so summing up their competitive advantage. Brand is strong in legacy video, maybe less so for OneWeb versus Starlink.
Fair assessment, yeah. Brand recognition for OneWeb is still building in that LEO space.
Cost advantages. They talk about synergies from the merger, but is it enough?
They project 80 million annual capex synergies, which sounds good, but measured against their debt and the potential scale efficiencies of someone like SpaceX, it's questionable if it's a sustainable cost advantage. Maybe more like keeping pace than leading.
Switching costs. High for the old TV broadcasters, but lower for new connectivity customers.
Generally true. Moving a whole broadcast setup is expensive. Switching your LEO internet provider might be easier, leading to more price pressure there.
So it really comes down to that unique asset.
That unique, fully integrated GEO-LEO network. That's their core claim, their most defensible advantage, being the only global operator that can seamlessly blend the two.
Offering bespoke, high-value hybrid solutions.
Exactly. That capability, plus their existing orbital rights and spectrum, that's the heart of their economic moat, if they can execute on it.
Okay, let's pivot to the people running this complex operation. Chapter 2, Management Evaluation. A new captain at the helm. Big change at the top recently.
Very significant. June 1st, 2025, Jean-François Filechat took over as CEO. He's an Orange veteran, deep telco background, but notably not from the space sector.
Interesting. What does that signal?
It signals a clear shift in focus from building the integrated network, which was largely achieved under its predecessor, to aggressively selling its services, integrating Eutelsat fully into the broader telecom ecosystem.
Right. His predecessor was Eva Bernanke. She oversaw the merger and got the IRS deal.
Correct. She was CEO from January 2022 to May 2025. You could say the board viewed her as the builder. Now they've brought in a seller in Filechat.
Though her departure seemed a bit abrupt, coinciding with financing needs.
The official lines were standard corporate speak, but yes, reports suggested it was a surprise. It raised some eyebrows about transparency, especially given the timing. The board itself has heavy hitters, though, like Chairman Dominique Dehinen and Vice Chairman Sunil Party-Mittal from Party Enterprises, a key player in the OneWeb merger and a major shareholder now.
Okay, let's talk capital allocation. The defining event, obviously, was that 2023 all-share merger with OneWeb.
Absolutely. A massive transformational long-term bet, pivoting the whole company.
And more recently, they cut their CapEx forecast for FY25.
Yeah, down from $700–800 million to $500–600 million. It's a bit of a double-edged sword.
Prudent, given the dead, or risky, falling behind competitors.
Exactly. It shows capital discipline, which is needed. But in this capital-intensive race against SpaceX and Amazon, who are spending billions, cutting back risks, ceding ground technologically or in deployment speed, is it proactive strategy or reactive necessity due to financial strain? Hard to say for sure.
And for shareholders, the dividend is gone for now.
Completely suspended for 3 fiscal years, FY23, FY24, FY25, explicitly to prioritize deploying OneWeb and paying down debt. A huge shift from their history as a high dividend payer, no significant share buybacks either.
Which leads us to return on invested capital, ROIC. How's that looking?
Not good. Starkly negative, actually, ranging from negative 3.6% down to negative 15%.
Meaning they're destroying value right now.
Currently, yes. It's a direct result of the huge OneWeb investments and those big impairment charges on the legacy GEO assets we talked about. Future ROIC hinges entirely on making this LEO pivot profitable. It's all potential at this stage.
All this strategy and management change is crucial, but let's get to the bottom line. Chapter 3, Financial Analysis. Deconstructing the numbers. What's the overall picture?
Turbulent and costly. That sums it up. The financials clearly show the erosion of the legacy business, the massive cost of the merger-driven pivot, and the resulting collapse in profitability.
Okay, key metrics. Market cap.
Relatively small for their scale, reflecting that skepticism. Around 1.1 to 1.2 billion.
Revenue trends.
Well, revenue actually declined from fiscal year 20 through 23. FY24 saw an increase to 1.2 billion, but, and this is key, that was purely due to consolidating OneWeb's numbers post-merger, not organic growth.
Oh, okay. And the guidance for this year?
Flat for FY24-25, which implies AO growth is currently just managing to offset the GEO declines. No net growth yet.
Profit margins must be under pressure, though.
Very much so. Gross margin is still high, around 81%, which is typical for satellite operators with high fixed costs. But the operating margin, sharply negative, between minus 16% and minus 55%.
Wow, why so bad?
Primarily those huge non-cash impairment charges. Remember the $535 million write-down on GEO assets in the first half of FY25? That craters the operating margin.
And the net profit margin?
Deeply negative, around minus 80%. The company is losing substantial amounts of money on the bottom line.
Okay, what about cash flow? Free cash flow generation?
It's under severe pressure. They don't report it consistently across all periods in the same way. But the dividend suspension and the CapEx cuts, those are clear signals they need to conserve cash desperately.
Any actual numbers?
The trailing 12-month, or TTM, free cash flow was reported at negative $124.7 million. So yes, confirming they are burning cash right now, which is worrying with high debt.
Let's look at financial stability then. Earnings consistency.
Historically stable, but now highly inconsistent and deeply negative. Net loss of $310 million in FY24, a huge loss of $873 million in just the first half of FY25. TTM earnings per share is around negative 2.09.
Ouch. Debt levels?
High leverage. Debt-to-equity ratio is around 97% or 1.10x. Their net debt to adjusted EBITDA is roughly 3.9x. That's quite leveraged, especially in a rising rate environment.
Anything positive on the stability front?
Well, their current ratio is healthy, between 1.36 and 1.73. That suggests they have enough liquid assets to cover short-term liabilities, so no immediate liquidity crisis seems apparent.
But the dividend stability?
Yeah.
Gone.
Completely gone. Suspended for FY23, 24, 25. Don't expect it back soon.
Okay, valuation analysis. How do you value a company losing this much money? The price-earnings ratio is useless, right?
Totally meaningless. TTM PE is negative, around negative 1.1x to negative 2.4x. You just can't use it. Tells you nothing other than they're unprofitable, so it's not investable based on traditional PE metrics.
So we have to look at intrinsic value, discounted cash flow, DCF.
Exactly. We have to try and estimate the future cash flows this business might generate if the turnaround works and discount them back to today's value. It involves making a lot of assumptions.
And given all the uncertainty.
The plausible DCF results produce a very wide range for the estimated intrinsic value, somewhere between 2.0 and 4.60 euros per share.
That's a huge range.
It absolutely is. And that range itself tells you how uncertain the future is and how sensitive the valuation is to your assumptions about LEO growth, margins, CapEx, and the discount rate.
What are the key assumptions driving that range?
You need multi-stage growth, strong double-digit growth from a LEO eventually, offsetting mid-single-digit declines in GEO. You need a high discount rate, or WACC, weighted average cost of capital, maybe 9% to 11% to reflect the high risk, especially with their current average cost of debt already near 5%.
And significant spending near term.
Yep, that reduced but still significant CapEx of 500–600 million in FY25 before assuming it tails off after 2030 once the main LEO deployment is done. Small changes in any of these assumptions drastically swing the valuation.
Okay, that sets the stage for part 2. Let's move into chapter 4. Market sentiment, the voice of the street. How are the professional analysts seeing this?
Not very positively on the whole, deeply divided and generally pessimistic. Analyst price targets are all over the map, from a low of 1 euro to a high of 7.04.
Wow, that's a massive spread. What's the average?
The average target is somewhere between 2.82 and 3.46. Still above the current price, but not by a huge amount, and reflecting that division.
And the consensus rating? Buy, hold, sell.
Overwhelmingly negative or cautious. Out of 9 analysts covering the stock, there are 0 buy ratings, 3 holds, 6 sells.
6 sells. Ouch.
Yeah, the consensus is basically a moderate sell. It suggests the professional analyst community, on balance, isn't buying the turnaround story yet. They're seeing more risk than reward.
What about recent news flow? How has that impacted things?
It's been mixed, leaning cautious. On the negative side, you saw several analysts decrease their price targets and cut earnings estimates in May and June.
And that Hanwha stake sale.
Right, that was significant. South Korea's Hanwha Systems selling its entire 5.4% stake in early June. That's a strategic partner heading for the exit, a pretty strong bearish signal.
Any positives?
While they did reinforce their partnership with Orange, the telco, the new CEO appointment was seen by some as a potential positive catalyst, and there was that brief price spike related to Ukraine possibly needing satellite capacity, highlighting the geopolitical angle. But mostly, the recent news hasn't shifted the negative sentiment much.
Looking at market indicators, short interest. Is it heavily shorted?
It has been a major target, yes. Short interest climbed as high as 18% of the shares outstanding at one point. It dropped back to around 6% after the Eutelsat contract was secured, which maybe squeezed some shorts out.
But still significant short positions.
Definitely. Prominent hedge funds like QBE and Darsana still hold large short positions, so there's serious money betting against Eutelsat's recovery.
And technically, how does the chart look? Price versus moving averages.
Very bearish. The price at 2.31 is trading significantly below both its 50-day moving average, around 3.54 euro, 3.68, and its 200-day moving average, around 3.36 euro, 3.40.
So a clear downtrend.
A strong, confirmed downtrend based on those technical indicators.
Okay, let's shift to who actually owns the company.
Yeah.
Chapter 5, ownership structure. A constellation of influential stakeholders. It sounds like it's not widely held.
Not at all. The ownership structure is highly concentrated. Very unusual for a public company of this size.
How concentrated?
The top 4 shareholders, Harty Space, from the OneWeb side, BPI France, the French state investment bank, the UK government, also via OneWeb, and SoftBank, an early OneWeb investor, together control over 57% of the shares.
Over half the company held by just 4 entities.
Correct. They have effective majority control.
What are the implications of that? Good or bad?
Both, arguably. On the one hand, it provides potential long-term stability and strategic alignment. Government backing, support for projects like IRSET.
The downside.
Potential conflicts of interest. Are the strategic priorities of India, France, and the UK always going to align perfectly with maximizing value for minority shareholders? Maybe not. Their agendas might diverge.
What about management? Are insiders buying the stock at these low levels?
That's another interesting point. The data is sparse, but there have been zero open market buys or sells by corporate insiders reported in the last 12 months.
Zero. Not a single buy.
According to the data available, no. Which you could interpret as a potential red flag. If management truly believed the stock was deeply undervalued, you might expect to see some personal buying.
A lack of conviction, perhaps.
It could be seen that way. Or maybe blackout periods or other reasons. But it doesn't exactly inspire confidence. So as an investor, you need to realize you're becoming a minority partner alongside these very powerful national and corporate stakeholders.
Definitely something to consider. Okay, let's get into the thick of the risks. Chapter 6. Risk Assessment. Navigating the headwinds. A SWOT analysis seems appropriate here. Strengths.
We've touched on them. The unique integrated GEO-LEO network is number one. They have an established legacy business and customer base, even if it's declining. And they hold valuable prime orbital slots and spectrum rights. Those are real assets.
Weaknesses.
Big ones. High leverage and a weak balance sheet. That net debt to adjusted EBITDA around 3.9x is significant. Negative profitability and ongoing cash burn, and just massive execution risk.
Integrating two huge, different companies, cultures, technologies.
Exactly. While trying to realize synergies and commercialize brand new, complex services in a hyper-competitive market, it's like trying to rebuild a plane while flying it through a hurricane. The execution challenge is enormous.
Opportunities.
Huge market growth and connectivity demand. They just need to capture their share. Strategic government contracts like IRS are a major plus. And the potential convergence of satellite with 5G NTN networks opens up new possibilities.
And threats. The big ones.
Intense and asymmetric competition is top of the list. SpaceX, Starlink, Amazon Kuiper, they have scale, funding, sometimes lower costs. Technological obsolescence is always a risk in this sector. And that internal threat of accelerated customer cannibalization, ELO, eating GEO faster than expected.
What about macroeconomic factors?
Sure.
Inflation, interest rates?
Inflation obviously pushes up costs, but interest rates are the most significant macro factor right now, I'd say.
Because of the debt.
Precisely. With high leverage, rising rates directly increase their debt servicing costs and make future refinancing much more expensive and difficult. Their average cost of debt is already nearing 5%. It puts a financial squeeze on them.
Geopolitical factors. Any specific risks or opportunities there?
Well, hypothetical U.S. tariffs could hurt their competitiveness, but conversely, geopolitics is actually a major opportunity.
The IRES effect.
Exactly. The desire by Western governments for secure, sovereign communication networks as an alternative to relying solely on, say, Starlink is a powerful driver. This strategic imperative is a tailwind for Eutelsat.
Okay, we've covered a lot of ground. Let's pull it all together in Chapter 7, Conclusion. Synthesizing all these findings.
There.
It really is a tale of two potential paths.
Absolutely. Let's lay out the bull case first. What are the key arguments for Eutelsat succeeding?
Okay, number one seems to be that unique competitive moat. The world's only fully integrated GEO-LEO network.
Right. Offering sophisticated, multi-layered solutions that pure-play LEO operators can't match, positioning them for high-margin enterprise, mobility, and government contracts.
Second, they're positioned in a massive growth market, global connectivity. They just need to execute to capture it.
Third, that strong sovereign and strategic backing, French and UK government ownership, the central role in IRSA. It provides a powerful backstop, arguably de-risks the investment somewhat.
And finally, the argument that it's a deeply undervalued turnaround play. Stock price is historically low, potential for a re-rating if LEO commercialization works, and maybe the new CEO is the catalyst needed.
That's the essence of the bull case, a unique asset in a growing market with strong backing, currently mispriced by the market.
Okay, now the bear case, which the current price seems to lean towards.
Argument 1. Eutelsat is essentially a melting ice cube with a crushing debt load.
Meaning the profitable legacy GEO business is declining, maybe faster than expected, being cannibalized by LEO. And they're funding this difficult transition with way too much debt. It's a perilous race against time.
Argument 2. They're simply outmatched in a brutal competitive arena. Can they realistically compete head-to-head with Starlink's scale, low-cost model, and vertical integration? Or Amazon's coming onslaught, plus renewed competition from a combined Sesintelsat?
Right. Argument 3. Persistent value destruction.
Yeah, the deeply negative ROIC, the massive impairment charges. It suggests past investments haven't paid off. there's a real risk that the billions poured into LEO might also fail to generate adequate returns, continuing the pattern.
It's like that saying, when the tide goes out, you see who's been swimming naked. Rising interest rates are definitely pulling the tide out for leveraged companies.
Well put. And finally, argument 4 for the bears, high risk of dilutive financing.
Because they're burning cash, have high debt, and still need to spend a lot on CapEx.
Exactly. If they need to raise more capital, issuing equity at these depressed share prices would severely dilute existing shareholders. And that lack of insider buying we discussed, it just fuels these concerns.
So wrapping up the valuation picture, that wide intrinsic value range, 2.0 to 4.50 points this year, really reflects this profound uncertainty.
It does. And the current share price, 2.31 as of our analysis date, sits right at the bottom end of that range. The market is clearly pricing in a lot of the bear case right now.
So for a disciplined value investor, this looks like a special situation maybe, but only if you have really strong conviction in the bull case.
I think that's fair. You need strong conviction that the GEO-LEO integration provides a lasting competitive edge, that the new management can execute flawlessly, and that the government backing translates into sustained commercial success.
Because the risks are clearly substantial, tangible. This isn't your standard value pick.
Not at all. It's a high-risk bet on a multi-year transformation happening in one of the most dynamic, competitive, and capital-intensive industries out there right now.
So maybe a final provocative thought for our listeners. As you think about Eutelsat's journey, the question isn't just will they succeed financially?
Right. Perhaps the deeper question is whether the growing strategic importance of space to governments, which we see clearly with IRES, might fundamentally change how we even value companies like Eutelsat.
Moving beyond just traditional financial metrics.
Maybe. To include things like geopolitical indispensability, what does value truly mean in this emerging new space economy? Something to mull over.
Definitely food for thought.
Yeah.
We really hope this deep dive has given you a clear, concise, and incredibly detailed understanding of Eutelsat Communications.
It's a complex one.
It really is. For more deep dives like this, please remember to like this video, subscribe to the Stock Analytics AI YouTube channel, and if you're a member, drop your ticker suggestions in the comments for priority analysis. We genuinely love tackling the challenging companies you suggest.
Yeah, keep them coming. And just the standard reminder, this analysis was generated by an AI system purely for educational purposes. It should absolutely not be considered financial advice.
Always do your own thorough research, or better yet, consult with a qualified financial advisor before making any investment decisions. Thanks for diving deep with us today.